These are dark times. The collapse of several investment banks, insurance giant AIG, and the US dithering over rescue packages have sent global stock markets into turmoil. Assets are falling around the world at an astonishing rate. It seems that wealth is simply evaporating into thin air.
What's happening at the moment, of course, is that banks are holding any liquidity that they have. Obviously, banks that are experiencing problems can try and get liquidity from elsewhere. The first port of call at the moment, of course, is the central banks. Other banks, of course, are also looking for investments from outside, from sovereign wealth funds or from the private sector.
And there is money out there. Oil sales in the Gulf are generating nearly $2 billion a day. Sovereign wealth funds and governments have an estimated $3 trillion invested in the US. But several have had their fingers badly burned bailing out the West. Kuwait Investment Authority plowed $5 billion into Merrill Lynch. Abu Dhabi sank $7.5 billion into Citigroup, and the Qataris' 20% stake in the London Stock Exchange has more than halved in value in a year. With hindsight, none of these investments could be described as prudent.
We are looking at the turning of a page in world financial history. And so the sovereign wealth funds of the Arab world have made investments just like all other investors globally did, with the best foresight possible, without the benefit of 2020.
And as people around the world start to see the scale of the problem, there has been a rush for the traditional safe havens. Demand for treasury bonds has rocketed, as has the price of gold, hitting $900 an ounce. But amidst all this chaos, could people be missing a trick? Central banks like the Bank of England behind me are providing liquidity, injecting billions of dollars to keep the financial system flush with cash. The hope is that vast sovereign funds and well-positioned investors will regain confidence in the market, taking advantage of low prices.
I'm very sceptical that there'll be any sort of quick bucks to be made from what's happening right now. I think in general we face still a very uncertain investment landscape across pretty much all assets, and it's not a good time to buy.
Indeed, far from snapping up cut-price investments, it looks like the risk era is over. If there's one characteristic that will define the coming years, it is caution.
Absolutely. We will see a more risk-averse attitude. We'll see a more discriminating attitude with respect to investments, in particular made in Western financial markets. We have already seen over the course of the past 18 months a further diversification of investments toward Asia.
That diversification aside, the fallout has muted the theory of decoupling, at least for now.
I think what we underestimated was the size of the seismic shift that would be necessary to deliver decoupling. And so I think what we're living today is a seismic shift in global financial markets that is the beginning of the process of decoupling.
And only the beginning of the turnaround.
It's similar to a quote that Winston Churchill used about the military campaign back in World War II. He said that it's not the end, it's not the beginning of the end, but it might be the end of the beginning. And perhaps that end of the beginning is where we are right now.